The broadcast is now starting. All attendees are in listen-only mode.
Thank you for joining the Financial Brokerage webinar today on Linked Benefits, the innovative way to sell long-term care with Brian Leising and Matt Nutzman of Financial Brokerage. The session is about to begin. There will be a question and answer period at the end of the webinar. All questions must be typed. This can be done at the bottom of the control panel on your screen. So without further ado, I want to welcome Brian Leising.
All right, good morning, everybody. This is Brian Leising, Life Insurance Sales Director at Financial Brokerage. Thank you for taking time out of your busy mornings to join us to learn more about Linked Benefits, the new way to purchase long-term care. You know, we've really seen a huge increase in the sales of these products over the past few years, and we'll take a few moments this morning to give you some insight into what those increases have been, why people purchase these products, exactly what they are, what makes something a hybrid or a linked benefit policy. What are the key demographics you should be looking for out there, whether it's among your existing clients or new prospects. We'll discuss where we can help your clients find the money to pay the premiums, and we'll also get into the various types and styles that are available. I find through my daily conversations, a lot of folks might be familiar with one type or style of a hybrid or linked benefit product, but they're not aware of all the others out there, and consequently they sort of write off a lot of people that would be really good candidates to purchase something here. So we'll try to dispel some myths along the way here. I'll be speaking first, and then Matt will join in since he's our linked benefit annuity expert here, and also has a lot of experience out marketing and in the field very recently here. Linked benefits, simply put, they're life and annuity-based products that link a long-term care benefit together onto that base contract. Many of you have sold some already, and some of you, are wondering what the heck are these things and are here to learn more. So, this kind of goes back to the basic need for long-term care. And, if you think about it, the high cost of extended care is really the greatest threat to our clients' assets should they become ill or frail as they age. The high cost of long-term care is going to wipe out their money faster than a downturn in the stock market. We all saw what happened in 2008. The market's back to where it was before. But you know what? If somebody needs long-term care, that money is leaving their accounts very quickly, and it's not coming back. And this sort of thing, too, if you think about it, it happens very gradually. It's not just an overnight sort of thing. A person that ends up needing a lot of care, they start off maybe needing some help shopping, or they can't drive anymore. They need someone to take them to the store. Then it turns into they need someone to come and help clean their house. And relatives can do this to a point, or friends, and after a while you get to a point where you just have to pay somebody to do it. The friends and relatives just can't handle it. Eventually it gets to the point where a person can't handle their activities of daily living, bathing or dressing or what have you, and then the costs really get up there. Well, what are the costs? Well, I did a little research here. Genworth did a cost of care survey last year, and the national median rate annually for care in a nursing facility, skilled nursing, is about 81 grand. Think how long is your client's money going to last at that rate if they have to subtract 81 grand a year? In some places around the country, it's going to cost a lot more than that. Now, let's say someone isn't in an actual nursing home. They're in an assisted living facility. They can handle some things themselves. Well, then we're looking at about half the cost, but still at nearly 40 grand a year, how long is their money going to last? And let's say that they would like to stay home. Well, then the cost is actually higher. Now, the number they gave us was, again, just shy of 40 grand, but that assumes a 40-hour work week. So some other friend or relative is taking care of them in the evenings and on the weekends. If you extrapolate that out to full week, let's see, 40 grand times 24 hours a day, I think we're coming up to about 120 grand just for a 5-day week, and then someone else still has to come in on the weekends. So their money is just not going to last. They have to have some other resource. If their money runs out, then they're on Medicaid, which is a fancy word for welfare. So what can you do? Well, you can either be Bill Gates or Donald Trump and you're incredibly rich, or you buy an insurance policy. And what people have done in the past, they have purchased a long-term care insurance policy. That makes sense. You buy a policy that fits the actual need. It's meant to cover these sort of events. Well, traditional long-term care is great, and it still fits in some situations. It's still the tool that does the job, but there are some problems out there. We've noticed sales are decreasing. Premiums are going up, and we see a lot of carriers exiting the market, and that's only going to exacerbate the problem because now they're getting all of the business. They don't want all of the business. They just want some of it, so they're going to try to do things to keep them from getting the business. Premiums are going to go up even higher. Underwriting is going to get tighter, and it just gets worse and worse and worse. You compound that on top of people giving you all of the usual objections to long-term care, like, oh, I'm afraid I'm going to die before I ever use the benefits. I don't think I should buy this. And it's just not a good situation. As a result, people are not getting the coverage that they really need to have. So what's the solution? Well, one solution, we've seen this one is actually working. Linked benefit product sales are increasing. They have the last 5-6 years or so. How much? Well, I pulled some numbers from LIMRA. They do studies of these things, and we can see back in 2009, linked benefits amounted to $800 million in premiums. Now that number went up by 1.5, so about a 50% increase from 2009 to 2010, and another tremendous increase in 2011. You know, we're getting up close to $2 billion in sales, and you know, if you look at that increase, it's just been tremendous over the past 5 or 6 years. I'm sure 2012 it was even higher. So there is tremendous opportunity in this market. A lot of your peers out there are selling this like it's going out of style. You can see by the numbers there. So you need to make sure that you're getting your piece of that, because if you don't bring it up to your clients and prospects, I guarantee you, these numbers prove it, somebody else is. And I think a lot of somebody else's are. So it's important to know what's out there and make sure you mention this to all of your clients. Now, what's driving these sales with consumers? In talking to the producers I work with that sell a lot of these products, there seem to be 2 main drivers of the sales. One is a guarantee that the premium will never change. With the traditional LTC policy, it's a health insurance product. That's how it's filed with the states, and carriers can increase rates on those even on an existing book of business. They have to, you know, go through some paperwork to do it, but they can do it, and they have. And clients really don't like that. So they like that peace of mind that they can get their premium locked in. Also, I mentioned this a little bit earlier, consumers like the fact that a benefit will be paid out. There is a 100% guarantee something's going to be paid out. If it's a life policy, they die, their heirs get the death benefit. If they need to use LTC, they're going to get that benefit while they're still living. So 2 important guarantees, especially if the economy isn't doing well, people gravitate towards guarantees, and that's exactly what we've seen here. There are some things that all these linked benefit products have in common, whether it's a life insurance-based product or it's an annuity. They're all filed as insurance products. They're not a securities product. All it takes is a life or a life and health license in some cases to sell these. With all of them, that benefit is accelerated to help pay for the long-term care expenses, whether it's life or an annuity. And then the qualifier to be eligible, they all include you know, the loss of 2 of 6 activities of daily living or severe cognitive impairments such as Alzheimer's. If you're familiar with traditional long-term care, you're going to see the same triggers in there. Now, there are several different types and styles, both of the annuity-based contracts and the life contracts. That's what we'll get into a little bit down the road. But before we jump to those product specifics, Matt is going to speak here, and he's going to answer some questions regarding who's a good prospect, who should we be looking for in our client files, and then he'll start off going into the annuity specifics. So, Matt?
Thanks, Brian. Really the key to success in this market is finding the prospects. As agents, we always want to find more prospects, and we need to be aware of the clients to look for in this hybrid market. Typically, the clients to look for are ages 50 to 75. And I know Brian shared with me a great stat here this morning from LIMRA. Nearly 40% of hybrid clients are ages 50 to 69. And typically these clients, they prefer to self-insure for long-term care. They're the people that think, I'll never need long-term care, or I don't want to buy it. And typically these people have a large amount of lazy money laying around. They're worried about paying for ongoing long-term care premiums. They're worried about rate increases. And they're looking for, and typically what we're seeing is more of a trend lately, is they're looking for additional coverage to their existing long-term care plan because their long-term care plan just experienced a rate increase, and they had to take off, some type of cost of living adjustment or reduce their base benefit to keep their premiums affordable. So the hybrid product can come in here and be an add-on to make up for that lost coverage. The other thing that we're seeing is people want, specifically the baby boomers, they want liquidity. They want to be able to maintain control and flexibility of their money, and they want to be able to walk away if they don't need it. So live, die, or quit, one way or another, they're getting paid. Finding the money. This is the next step in this market. In the business market, you're going to want to look for non-qualified deferred comp recipients, bonus recipients, and then recent sellers of businesses and farms. And we're seeing a lot of farmers right now, they're sitting on a ton of cash. I mean, they're making a lot of money, and they don't know what to do with it. The money's sitting at the bank. They all love their banker. And, that money's sitting in CDs right now, and it could be sitting in a better place for them, in a product that they can get a better rate of return, and, they can also get a long-term care benefit as well. Among individuals in families, a couple things to look out for. DI and life policyholders with the return of premium feature. You can access that return of premium funds to, fund a hybrid type product. Also permanent life policyholders who no longer need as much death benefit, or maybe it's, the life product that they purchased is a little out of date, or it's a variable product, maybe it's the costs are eating up the cash value, and we could move it over into a hybrid product that would perform better and actually accomplish their needs. Also deferred annuity owners. Annuity rates aren't what they used to be. So it's time to review those annuity products and see if the hybrid's a better fit. Also, like I said before, people with CDs come and due, that lazy money, prime suspects, homeowners are downsizing. A lot of baby boomers are, trying to downsize and save money and secure their retirement. Now's the time to talk to them, about protecting themselves and their long-term care risk. There's a couple different types of linked benefits. On the annuity side, we have a single premium type deferred annuity contract. We also have flexible premium options. On the life side, we have single pay, multi-pay. So there are several different ways that we can design these types of products. It's not one size fits all. So definitely, feel free to call Brian or myself, and we'll be able to find the right product for your client. Linked benefit annuity advantages. This is kind of where I come into play. Typically on the annuity side, we have a higher benefit that's available in the fund early on in the plan, typically. Also, this is probably the most common use of hybrid annuities. Basically, it's a funding resource. Clients who already own an annuity can only transfer funds to another annuity, not a life long-term care hybrid. So that's typically where the annuity products come into play as most. And you'll probably see that on average, talking with Brian, that you'll see a higher long-term care benefit on the life products. But, if the money's sitting in an annuity already, we can only move it to an annuity. Inflation protection, most of the long-term care annuity products do provide, 2 to 3 times the accumulated value pool of money for long-term care. And also, most annuity products have an inflation protection endorsement as well. It is very expensive, though. And then underwriting. There's just fewer underwriting requirements compared to life hybrids. And I'll get into a couple of the indexed annuity products here that have no underwriting, and those are becoming more and more popular. As far as specific annuity products, we had the living care annuity. I left that in here to illustrate a point. Not all of these products are going to be on the market forever. And, you know, I lined up a whole bunch of these sales, and United of Omaha pulled that living care annuity product. So it's one of those things to be aware of in this low interest rate environment. If you have a client that's interested in a product like this and they have the money and it's a good fit for them, you have to push them. You just can't let them sit on the sideline. And then a couple other annuity products that we're seeing written. We have the Annuity Care 1 and 2. We also have the long-term care fixed annuity with Lincoln Financial, which is very similar to the living care annuity with United of Omaha, and that product's still on the market. And then the annuity riders becoming more and more common, especially on the index side of the business. We have the Edge Plus rider with Aviva. We also have the protection package with Fidelity and Guarantee. And in this next slide here with United of Omaha, I left this in here just to illustrate my point. But Lincoln Financial has a very similar product. It's just their long-term care annuity. Typically, really how it's designed is you receive up to 3 times the annuity value at the time of first claim in long-term care benefits. There's a pool of money to pay for at least 6 years of long-term care. You're earned a guaranteed rate of interest, and you have access to your principal through partial withdrawals or lifetime income. You also have the 10% penalty-free withdrawal after the first year, and provides a death benefit that's equal to the annuity value at the time of death. Definitely keep that in mind. Here's one thing I just forgot. There's only 12 health questions for that Lincoln long-term care annuity, and it's vitally important that as an agent that you pre-screen your clients in depth. And the reason I say that, I just recently had an agent call me 2 days ago, and he said, you know what, I had a decline on a long-term care case. What about that long-term care annuity you're telling me about? Well, the problem is on a lot of these annuity products, if they've been declined already, they have at least a 3-year waiting period before we can take another look at them. So definitely if underwriting is an issue or a concern, run that by us. Let's pre-screen this thing as much as we can, because I hate to have you wait 3 years to move this into an annuity product that may or may not be around. So that's really important when it comes to the annuity type products. State Life, they have the Annuity Care 1 and 2. It's a little simpler product. It's just issued as a single life or a joint life. It's a dollar-for-dollar benefit. Long-term care fund grows at a higher percentage rate. No medical exams, and it probably has some of the most liberal underwriting, as far as annuity products go. There is an option to purchase a rider to extend benefits for a lifetime. That's only on the Annuity Care 2 now. The other thing I just saw my little note here, a lot of these annuity products are not approved in every state, so you'll definitely want to give us a call and make sure it's approved in the state that your client resides in. Getting into the next slide here on the annuity income riders, Aviva has the Income Edge Plus rider. Essentially what this rider will do is it doubles your income payment if your client becomes confined to a nursing home and there's no underwriting. So if you have, the last call I took before I came in here, 76-year-old guy, actually, I'm sorry, a 72-year-old guy just got diagnosed with Parkinson's. So obviously we can't get him underwritten on any, life hybrid or some of the fully underwritten annuity hybrid products. So they're looking at this Income Edge Plus rider because of the no underwriting feature. The only catch is, you have to be confined for at least six months in a nursing home before that double income payment kicks in. The preferred index annuity product with an income rider that I like is the Fidelity and Guarantee Protection Package. And essentially, it's the same type of product as the Aviva where it doubles your income. However, your client only has to not perform 2 of the 6 ADLs for that double income payment to kick in. So they can get that double income payment for home health care and assisted living potentially. So, and there also is no underwriting with this as well. The only catch is the contract must be enforced for 5 years before they can exercise the double income payment. And then getting to the next slide here, on the life and long-term care hybrids. I think that's Brian. You want to take this over? Here you go.
All right. Thank you, Matt. Yeah, getting back, or I guess moving on over here to the life insurance-based linked benefit policies. I like to categorize those into really 2 main categories. We've got the single pay variety and the multi-pay. And the single pay varieties, those are really really the original hybrid policies. If somebody is familiar with this sort of a product, that's what comes to mind immediately. I can remember when I was out in the field, it was over 10 years ago now, getting invitations to seminars for this new innovative product that combined a death benefit, and then it took a lump sum to get it started, and you could also access the money for long-term care. And those are really the first models out there. They really appeal to the self-insurers, the people that have this large lump sum of money sitting around. The multi-pay products, these came around a little bit later. They really do appeal to a much broader market. Now you don't have to find a person who has $50,000 to $100,000, $200,000 sitting in the bank. You can find someone who can just afford a monthly or an annual premium, and they can get this sort of coverage. And this really makes it affordable for people that don't have access to that big lump sum. Give you an idea what kind of money we're looking at. I looked up some numbers from LIMRA the other day. These are their numbers from 2010. But with the single pay varieties, the average premium in 2010 was just over $72,000. Give you some idea what to be looking for out there, and that in turn gave an average face amount of about $123,000. So you get some leverage there. Now the multi-pay policies, they said the average premium was $6,000 a year, and gave an average benefit of just shy of $400,000. So if they can make that ongoing payment, we do have the ability for a little more leverage there. I'm going to go into a little more detail here. With the single pays to start with, we've got about 4 carriers offering this model of linked benefit product. I chose Genworth just out of the blue, but I plugged into the software a preferred non-smoker male age 60 years old, and I said, we have $100,000 he wants to put into this product. What will that buy us? And it gave us a death benefit of just over $200,000. And a pool of money to use for long-term care that came to just over $400,000. So you get a lot of leverage just with that death benefit alone. But look at that long-term care benefit. If this guy had $100,000 sitting in the bank he was intending to use for long-term care anyway, look, we just quadrupled what he has available for care, and that's a lot of leverage. Now, where can you find the money to leverage? Well, here's some examples. I know Matt went over these earlier. Quick recap, existing savings. If you're sitting down with somebody doing a review of their assets, maybe you're on an annuity sales call, or just doing a review of everything they have, see if you can get them to bring out their tax return from last year. You can learn a lot off of those, and you can see what sort of assets they have, and just ask them. I see you have this account over here, this CD in the bank, and you have several CDs in this bank. Is that money you're saving for retirement? Is that for emergency purposes? But what are the purposes of these funds? And you're going to find that some of those funds are set there for emergencies. And then you're going to have to ask the person what emergency is going to cost you $200,000. And when it comes down to it, it's not that they need a new car, new washer, dryer, remodel the kitchen, what have you. They were afraid of the cost of long-term care. And that's the money you can then move into something that can give them a lot more leverage. You don't want to forget about existing life insurance policies. Some folks have cash-rich ULs or maybe cash-rich whole life policies, and they don't have a whole lot of leverage. I was looking at one the other day for a person. I think they had 40 grand of cash value and a $60,000 death benefit. I mean, it's really a $20,000 net death benefit. Why not leverage that money into something that's going to do the client a lot more good? So look at their existing life policies. You can, in a lot of cases, find something better for them. And don't forget about 401ks, 403bs. And this is going to be qualified money, but with the next slide, we'll talk about one of these products that can allow you to get to that money in a way that the client doesn't take such a big tax hit. So going into more detail with the single pay products that are available, a lot of these are based on a UL chassis, and they are crafted to be modified endowment contracts. They are extremely cash rich, and it's fine. I mean, all NEC means is if you take out growth, you're going to be taxed on it just like you would growth in an annuity. But you know what? Between the interest rate and then the charges that come out for the cost of insurance, you're really not going to see much of any growth in these products. And if you need to use the benefit for long-term care purposes, that all comes out tax-free anyway. So you don't have any worries with that regard. State Life with their asset care product, they put theirs on a whole life chassis. You can get a little better return on your money inside of those. And they are also rather unique in that they have a second-to-die version of the product available. I know the shared benefits are very popular with traditional long-term care. You can do that sort of thing with State Life's asset care product. Stats are that 1 out of every 2 people is going to need long-term care before they die. If you have a husband and wife, you now have a 100% chance that one of them is going to need it. Which one, we don't know. Put them together on a second-to-die policy, and you've got it covered that way. I mentioned earlier there's a way to get money out of 401ks, 403bs, even getting money from annuities. That Asset Care 2 can allow you to pull money from a non-qualified annuity. The Asset Care 3 can let you pull money from a qualified plan. Maybe it's a 401k. The mechanism they use is they'll take the money out of that existing fund and transfer it into one of their annuities. So there's no taxation there. Then they'll bleed that annuity out into their 20-pay whole life. So your client only has to pay taxes on the 20th of that gain every year. And they handle this all in-house. So you could do this outside of them. It becomes a little more complicated. You'd have to move the money into an annuity, then pull that out, or maybe move it into a SPIA, and the client would receive a check and then write a check, receive a check, and write a check. They're going to get tired of that pretty fast. So State Life has a mechanism to do that for your clients. Moving on to the multi-pay examples, and this is where we see the most business, really, in these types of products. I rounded down to that rounded up in this case, that $400,000 pool of money that we got with that Genworth TLC, and looked at a few carriers and thought I'd see what kind of premium would it take to drive that $400,000 pool of money, and came out with just under $7 grand a year for a premium, and that's a little bit higher than what we saw that average premium was. So we're right in there. Most of the carriers are all priced very close to one another. So now we're paying almost $7 grand a year, that same pool of $400,000. One difference here with most of these multi-pay products is we don't have an extra pool of money. Our death benefit and our LTC benefit are one and the same. Now, where can we find the money for this? Well, existing life insurance policies, I mentioned that earlier. Now we might not be looking for those that have got a lot of cash, but the client is already paying a premium for a life insurance policy. If it doesn't have a linked benefit rider or provision attached to it, let's give them an upgrade and give them something a little better. Maybe they pay the premiums out of their regular income. Maybe they're receiving required minimum distributions from all those qualified retirement plans, and they don't need the money. They're very frugal. They've got extra money, don't know what to do with it. You know what, let's help them find a place to put it and protect themselves along the way. Now, benefit payments, this is a common question I get with these multi-pay linked benefit products. How do they pay out to the clients? Well, there's really about 4 ways that I've seen among the carriers. They all do it a little bit differently, but one way which your client can receive a benefit is as a percentage of the face amount. Usually we see 2%. So if they have a $100,000 policy, they're then going to be eligible for $2,000 a month in long-term care benefits once they lose those ADLs. Another way they might receive their benefit is as a specified dollar amount. We have one carrier that lets you go into the software and say, my client would like $3,000 a month, or $5,000, or $8,000 a month. You can tell them exactly the exact dollar figure that they're going to be receiving when they go on claim. A couple of the carriers make it a little more complicated to figure out exactly what the client is going to receive. They underwrite at the time of claim, try to figure out the life expectancy of your client at that point in time based on their medical records. Basically, the closer to death your client is, the more money they're going to be eligible for. And they also take into account some actuarial factors that are too complicated to get into here. But you can get a large lump sum of money here. If you have a client that wants to know exactly what they're going to get, when they're going to get it, it's a little difficult to be able to give them that answer. And then the fourth method of benefit payment with these products is a one-time benefit, again, determined by underwriting and actuarial factors. The nice thing about that is that they get one big lump sum. Maybe they had $1 million policy. Company says, okay, we're going to give you a lump sum of $250 grand, and that's it. I mean, that's going to last you as long as it lasts you, but they don't care where you're receiving care and how you use those benefits. So it's up to the client how they would like to receive that. As far as what carriers offer these sort of products, we have several, looks like about 8 now on the permanent side of things, and 4 of them offering it on a term insurance chassis. This is something new that's come around within the last year. Now, you might be asking, well, what good is a term insurance policy going to do? If my client's going to be 80, 85 when they go on claim, what's the point of having a term life with this sort of rider attached? Well, same question could be asked of, why are you selling a 25-year-old a term policy if you think they're going to die when they're 80 or 90? That 30-year term is going to run out. Well, look at it as a starter policy. If you get them started now, they're not going to want to let that long-term care benefit go away when they're older. You can move them into some sort of a permanent plan down the road. Another reason to sell the term versions could be affordability. They can't afford the premiums right now for the permanent plan, but guess what? They can afford the term, and this sets the stage for a sale down the road. And another innovative way to use this, I stole this idea from Matt, and he said this would be great to use as a supplement to a high deductible major medical plan. A couple of these term policies actually let the client accelerate not just for chronic illness, need for long-term care, but also for several critical illnesses. They have a heart attack, they're diagnosed with cancer. You can get to some of this money on those products that are written on a term chassis. So a great supplement to help pay those deductibles. Another way we can look at these multi-pay life-based products is how do they pay out the benefit, not just as a percentage, but do they have to prove that they've had actual expenses? Do they have to send the bills into somebody? Well, some of these carriers work that way on the reimbursement model. And several of them, though, and this seems to be the more popular model, it's an indemnity. So if you qualify for $5 grand a month, they're going to send you a check for $5 grand a month, no questions asked. They don't care who's providing care, where it's done, anything like that. There's your money. You do with it what you will. So it's a common question I get on these products. Something else I'm asked, do we need to take that long-term care continuing education that our state requires to sell traditional long-term care, or do I need a health insurance license? Some folks just have the life license out there. Well, this depends on the carrier. Some of these carriers want you to have that LTC continuing education, and some of them it depends on what state you're in. Others, the way they have the product filed, the tax code that they filed it under, you don't need to have that. And I guess that's another question I get sometimes as well. I don't have a slide in for this, but some of these products are filed under the section 7702B. Those are the ones that can be marketed as a true long-term care benefit. They're usually the reimbursement products, and that extension of benefits is available to some of those. A lot of carriers have chosen to file theirs under section 101G. There's a little less restrictions on the use of the proceeds, lower administrative costs. That leads to lower price to the consumer. Those products you are limited to just the death benefit being your pool of money. And on all of these, they're either guaranteed to be or intended to be tax-free benefits to the policyholders. Is a paramed exam required? Well, most of these do require a full paramed exam. It's part of that underwriting process. You can get the most bang for your buck if you go through full underwriting. But if you have a client that doesn't want to go through that for some reason, or if they're not in the greatest of health, and you know what, the rate won't be any different, whether they're fully underwritten at a table 4 or they get one of these non-med products, by all means, skip that extra step and go with one of these that lets you get by without that pyramid exam. So I've got a listing here, at least as of last week, of all of our life carriers that offer some sort of a linked benefit product. And as Justin mentioned earlier, if you have questions here, be sure and type them in, and Matt and I will try to get to as many as we can. But sort of in conclusion here, to wrap this up, we know that your clients need protection. The high cost of extended care, one of the greatest threats they will face between now and the end of their life, greatest financial threats anyway. And you can really offer them protection in any way that they prefer, whether it's an annuity-based contract, a life contract, a single pay, a multi-pay, a traditional long-term care policy. So lots of options out there, and you can really customize it for your clients' actual needs. And as we're looking up the questions here, keep in mind, if you know of someone else out there who maybe should have joined us for this webinar, you think they would have great interest in it, or their clients would have a need, by all means, don't keep them a secret. We'd love to see what we can do to help them. Maybe you know a long-term care specialist or an annuity specialist, a registered rep that hasn't protected their clients' assets. It's a lot easier to work with existing clients than to have to go out and find new ones. Maybe there's a life specialist you know that you could pair up with, or a health insurance specialist that's looking to diversify their product offering. So we'll take a look and see if we can go through some of these questions here. All right, one question I'll answer as best I can here. We've got a person asking about an example of using 401k money to purchase a product when the client is in their early 50s. Yeah, I don't have immediate access to the software right now, but I can kind of help you visualize how that might work. They can transfer the money from the 401k into, and State Life is the one that has this available, into a State Life annuity. And then State Life will take that annuity and pull out roughly a 20th of that money every year and put it directly into their whole life product that has the linked benefit, LTC benefit, attached to it. And then that's going to go on every year for 20 years. I sort of visualize it as a big hourglass up there. The annuity money is on top, the life insurance cash value is on the bottom, and at the end of 20 years, the annuity has been drained dry completely. And they'll 1099 the client for whatever that taxable portion is, or if it's 401k, I guess it'd be entirely taxable every year. But that avoids them having to pay tax on whatever that entire lump sum was all at once. And then here, if they're in their early 50s, there's going to be a penalty on top of that. So that helps in that regard. And let's see if there's something else out there right now. I'll put in a little plug for a webinar next week. We are going to have one of our carriers go a little more in-depth into one of these products here. We're going to be welcoming Jeff Waddington to speak about GEMRIT's total living coverage. And so be sure to join us on Thursday of next week. I believe it's the 28th. I don't have a calendar in front of me, so I could be wrong on that one. And you can also check out our YouTube channel on our website, fb-inc.com. We recorded this webinar, and you'll be able to watch this one and all the others that we've done over time out there at your leisure. And chances are, if with an email, we could also get you copies of the slides if you would like those as well. I'd really recommend the YouTube version, though, because you can get the audio that goes along with it. Our website is www.fb-inc.com. In fact, I've just put it up on the screen for the person asking there, fb-inc.com. And if you're looking for these YouTubes, we've got a toolbar at the top. You can go to the far right. It's going to say Sales Tools and Training, and then in that drop-down, look under Training, and you'll find our YouTube channel out there, and you can see this one and several of the others that we put on a regular basis. Well, I'd like to thank everybody for joining us this morning, and be sure and catch the one on the TLC next week, next Thursday, and catch us next month for the next webinar we'll be hosting. Thank you for your time, and have a good day.